Borrow against your stocks. Billionaires have most of their wealth tied up in stocks. If they sell the stocks, they have to pay taxes. So, to get around this, they call up the bank. They receive a low interest rate loan with their stocks as collateral. If the stocks go down, the banks might ask for more stocks to add as collateral, or the billionaire might have to pay some cash to keep the loan in good standing. In normal markets, this is easy cash and a great way to avoid taxes. Yes, they still have to pay interest, but the low interest rate is usually much lower than whatever their tax bill would have been if they sold. Also, since they didn't sell their stock, they get to benefit from it going up in value. It could increase in value more than the cost of their interest, making the whole deal a no-brainer. They get money to spend without losing a money-making asset. Use mortgages to buy property. In November 2013, Blackstone's rental home division, Invitation Homes, bundled the rent from 3,207 houses and used it to raise $479 million, a first-of-its-kind deal at the time. This showed how big players scale real estate. Use a mortgage, or a pool of them, buy assets that pay for themselves, then refinance and repeat. Here's how they do it in simple terms. Step 1, borrow to buy houses. They get mortgages to buy lots of homes. Step 2, they get renters. People move in and pay rent every month. Step 3, they put the rent in a special box. They make a tiny company that only collects that rent and pays bills. Step 4, they sell IOUs to investors. The rent collecting company sells bonds. Investors give cash now. The bond says, we'll pay you each month using the rent. Step 5, backup plan if things go wrong. The houses are collateral. If payments stop, investors can take or sell the houses. Step 6, they use the cash to grow. With investor cash, they pay off earlier loans and buy more houses. And finally, step 7, refinance and repeat. When rates are better or house prices rise, they swap their old debt for cheaper debt and do it all again. Insurance float. This is Joe, your average guy. He pays his car insurance bill every month and hopes he never has to use it. Meanwhile, the insurance company is collecting Joe's payments. They invest that money for years and pay the claims whenever they pop up. For Joe to use the money, he has to have some kind of incident with his car and hope that they approve his claim. And even then, they're going to be stingy with how much they give him. See, insurance payments are called premiums. Companies receive the premiums up front. This is a liability, which is like debt, because they only pay the claims in the future. This gap between collecting and paying is called float. They can use the float to invest in stocks, bonds, or entire businesses. A genius tool to use other people's money for your investments. Buy companies with debt. Billionaires and private equity companies borrow money to buy a big cash-generating company, then use the company's own profits to repay the loan. That's the leveraged buyout, or LBO. Owners put in some equity, banks provide a lot of debt, and the target company's cash flow carries the load. If they improve operations, sell a few non-core pieces, and pay down debt, their small equity stake can grow massively. It's high stakes, but it works often enough to create fortunes. Sell bonds to fund growth. In April 2013, Apple sold $17 billion in bonds, the largest corporate bond sale at the time, even though they were swimming in cash. They did this because debt was dirt cheap, interest is tax deductible, and issuing bonds let Apple reward shareholders and invest without bringing overseas cash back to the United States and paying extra taxes. When your credit is great, you can borrow on friendly terms, keep control of your company, and still bankroll expansions, acquisitions, or shareholder payouts. Bonds are just tradable IOUs. Borrow to buy back shares. A company raises debt and uses the cash to repurchase its own stock. Share count goes down, so each remaining share represents a bigger slice of the pie. Earnings per share often look better, which can nudge the price up. Founders and early owners like this because their percentage ownership effectively grows without them spending a dime. Interest is a business expense, so it can reduce taxes, and if the stock is undervalued, it's an efficient use of capital. Leverage the portfolio. You borrow from your broker to buy more stocks than your cash alone would allow. If your stocks rise, your gains are multiplied. If they fall, losses are multiplied, and fast. Brokers set minimum cushions. If markets drop below those cushions, you get a margin call and may be forced to sell everything to pay them back. Billionaires use margin when they see a clear edge or short-term opportunity, and they typically do it alongside other, safer borrowing methods. The appeal is obvious: amplify returns, but the risk is real. Leverage makes small mistakes expensive. Some of the biggest losses in history were due to leveraged portfolios. Build with construction loans. Developers don't show up with a suitcase of cash to build a tower. They line up a construction loan that funds most of the cost while the building is going up. Before a shovel ever hits the dirt, they try to lock in tenants or pre-sales, which reassure the bank that rent or sales will repay the loan. When the building is finished and leased, they can refinance into a longer-term mortgage at a lower rate because at this stage, it's much less risky for the bank. With the new loan, they pay off the construction lender and often pull some cash out. That cash becomes the down payment for the next project. Rinse, repeat. Borrow to build, stabilize the asset, refinance on better terms, and roll the equity into the next deal. Borrow to pay yourself. In 2010, hospital chain HCA borrowed billions and paid a giant one-time dividend to its private equity owners. Cash today without selling the company. Lenders played along because hospitals generate steady cash, and a year later, HCA returned to public markets just fine. The headline: borrow at the company level, wire money to the owners, and keep the business. Let customers prepay. You may have heard people saying that Starbucks is really a bank. Well, this is the exact method they use. Customers load their money into their Starbucks account, and this allows Starbucks to use their money for business operations. Deposits, annual subscriptions, and pre-orders are a way for companies to get cash up front. The mechanics are simple. Upfront customer money acts like an interest-free loan that funds inventory, hiring, and marketing. Gyms, software, airlines, hotels, and event promoters do this every day. They collect early, record it as deferred revenue on the books, and use the cash to build and sell more. It also locks in customers since they've already paid, smooths demand, and gives you clean signals about what to make next.